Dr. Lambu, we've learned about spread, open and closed positions, and the stop loss and take profit orders. What are we going to learn today?
Well done, boy. You seem to have remembered what we've learned in the last class. But things will get more difficult this time. Leverage. Leverage is used by a trader to increase the capital available for trading, hence magnifying his or her potential returns. The trader needs to deposit the principal amount in his bank or broker before using the leverage. Leverage has taken margin trading in Forex to a whole new level. It can help multiply your principal amount, which increases your trade size beyond your prior capability. However, please keep in mind leverage also increases your risk exposure. Higher returns are always associated with greater risks. Margin. Margin and leverage are inseparable. If you have $1,000 in your account and the leverage is 400 to 1, it means that you can trade with up to $400,000. If one lot refers to 100,000 units of currency, the $400,000 represents 4 lots. As such, we can use $1,000 as the margin. Rollover rate. In Forex trading, the rollover rate is the net interest to loss on a currency position held by a trader overnight. It refers to the difference between the interest rates of the base and quote currencies. For example, if you want to buy the Australian dollar to Japanese yen currency pair, you will borrow the Japanese yen in order to purchase the Australian dollar. If the deposit interest rate in Australia is higher than the loan interest rate in Japan, the gain will have outweighed the cost. Subsequently, you will have generated a favorable return by holding the currency overnight. On the other hand, if you sell the Australian dollar to Japanese yen pair, you will have borrowed the Australian dollar to acquire the Japanese yen. Assuming that Japan's deposit interest rate is less than Australia's loan interest rate, the cost will have outweighed the gain. Such a scenario is unfavorable to the value of traders' holding. It should be noted that the rollover rate may vary from broker to broker, but most brokers charge 3 times the usual rate on Wednesday. That's because they need extra interest at the weekend. In general, you have to pay an interest in some circumstances and collect gains in others. The rollover interest on Saturday and Sunday will be collected in a lump sum on Wednesday. So in this lesson, we've learned another 3 common terms, including leverage, margin, rollover rate. Will, are you ready for the quiz? That is all we've learned today. In the next video, we'll learn different types of Forex orders.